Great. Very good afternoon to all our viewers. And thank you for joining us today for the live session. We have a very interesting topic with a young, dynamic founder with us on climate tech for financial industry. We have with us Amos Wittenberg. He's the founder and CEO of Unwritten. He was a former journalist and have transited his career towards technology and focused on climate change. He's working with Palantir Technologies, and Unwritten is one of the key products which enables the investors to do the climate risk assessment and more on the asset management. And we'll try to learn more on what was his vision and how he forayed and the transition in his career. Welcome, Amos. How are you doing today?
Hello, thank you so much for having me. Great to be here. I'm doing very, very well. We've in the middle of our busiest section of the year, kind of between now and early December is when people are assessing their budgets, procuring tools, thinking about their strategy for the year to come. Obviously, this has been quite a remarkable and disruptive year in sustainability terms, and so we're having lots of very interesting conversations with clients and prospects at the moment.
Very interesting. Now, I would like to learn what was the reason for the transition from a journalist to a climate tech founder and leading Unwritten. What was your vision and mission behind it?
Yeah, I mean, I started my career writing about finance and in particular financial crime. So this was just out of school, and I ended up as editor-in-chief of a small publication that focused on topics that are pertinent to AML, anti-money laundering professionals, counter-terror financing professionals, and so on. So quite a niche topic, but in a way, not a million miles from what I'm doing now, insofar as I'm still concerned with thinking about how we regulate and manage sets of risks in the financial sector. It's just that those risks are to do with climate change rather than to do with white collar crime in different capacities. But there was quite an arc between those points. I went back to school for a period of time. I actually studied on an American program, but in Beijing, with a very interesting cohort, and in a context that was particularly focused on encouraging people to think about the broader mission that accompanies their career. So, being successful and doing interesting and productive and remunerative work is one thing, but also why are you doing that work when there are N things that you could be doing instead? And I think from there, I realized that the career path I was on in journalism wasn't fully satisfying to me. I actually had quite a quantitative skill set that I wasn't engaging that I wanted to use. And so on graduating from that program, I went and worked for the US tech company Palantir for a number of years. And while I was there, I was able to do two transitions, one of which was learning a more technical skill set. So I wouldn't call myself an engineer, but I was doing a lot of kind of deployed data science work and writing data pipelines. And the other was, and this was sort of around 2020. So as the climate tech and sustainability wave was really starting to gather momentum in Europe and in the US, but to move across sectorally to focus specifically on climate, and as it turned out, really climate in the context of financial services. And with a number of colleagues, I ended up building out a climate function within Palantir, climate and sustainability function, and doing a range of projects related to that work with different groups of colleagues. And that was really my introduction to the topic of climate risk and getting particularly interested in how we think about and make decisions around climate risk. And so that was what ultimately led to leaving Palantir and founding Unwritten with a colleague back in 2022, so 3 years ago now.
That's very interesting and inspiring journey, I must say that. Now, in a world drowning in ESG scores, how do we build real, actionable climate risk intelligence? Since you've been working in this, how does Unwritten help us?
Yeah, it's a very good and important question. I think the first thing to say is that we it took us a while, but we realized, after a year or two that we weren't really trying to compete with ESG scores as you might traditionally think about them. So when I think about an ESG score, I guess I think about something that is, with an open methodology that's weighing a range of factors, typically about a listed company, and it might be one among many factors that's used to weight the decision making of, let's say, a portfolio manager who's deciding which listed um, companies or listed securities make it into a portfolio. And we did some work saying, could we build better ratings that just specifically identify a company's exposure to the transition? So an ESG score is an aggregate product, and it will weigh many, many things, of which different aspects of climate risk, physical risk, carbon emissions might be part. And we said, well, we're really interested specifically in the transition piece. Our global economy is undergoing this remarkable kind of vast, very fast-paced shift of primary energy source that's quite likely to happen in our lifetimes. Those sorts of energy transitions always have extraordinary knock-on effects historically to pretty much every other sector because energy is, the primary sector of the economy. And so how might we map out the ways that different companies are specifically exposed in terms of revenues and costs to that transition based on what they do, where they operate, and so on. And we found it hard to cut through. I think people struggled to see why they would want such a specialized specific tool when you might just be looking at a broader aggregate rating. And we also realized that that in and of itself wasn't necessarily going to be a reason for someone to pick one security versus another. So the decision usefulness of that product was somewhat inherently limited. And so the product that has driven Unwritten's growth and that is everything that we do and serve to customers now is a little different. And it's a platform for looking at all sorts of climate risks, physical risks, so floods and wildfires and cyclones, and transition risks like carbon pricing, litigation, other kinds of policy, new technology, and nature as well. But at the a much more kind of specific and detailed level of a particular asset, so a particular building or a particular company. And we don't sell that really at all to participants in public markets. So it's not an ESG tool might be a portfolio weighting or even a security selection aid, whereas the clients using our tool are using it much more in operational terms. They're not using it to choose what goes into a portfolio, but they're using it to diligence risk on a new deal or to engage with and more effectively manage and steward companies already in the portfolio. So rather than being a sort of part of an abstract score on a listed company, we're providing very, very, very detailed insights into specific companies and their assets. And we're providing them to clients, typically companies themselves or participants in private markets who have a business model that means that that level of detail is useful to them because they have the illiquidity and the concentration and the timeframes to think at that level of detail about all the risks that might face a business or an asset.
And while you do so, what are the blind spots that you see that investors and operators, maybe the entrepreneurs, still have when it comes to climate exposure?
It's an excellent question. So on the, I think I'll split out my answer by talking about um, physical risk and then transition risk, which are the as discussed, the two classic kind of subcomponents of climate risk. I'd say on physical risk, um, one thing that I think people often struggle with is differentiating between um, systemic and idiosyncratic types of risk. So, for example, you have a company which is serving consumers with a particular kind of product. So let's say it's selling clothing. Um, and there's a very good chance that its supply chains are fairly diversified. It's getting those items from all over the world. And perhaps it doesn't even control its production. Perhaps that's largely outsourced. So it is true that it has a complicated supply chain, undoubtedly, and there are many assets in that supply chain that could be liable to being um, flooded or to being hit by a wildfire or being hit by a cyclone, or indeed even the transportation. So the items getting from the factory to the customer might be a real issue if there's more than usually stormy seas, let's say, or something like that. So undoubtedly there is a physical risk exposure, but it's not particularly manageable, other than by keeping an eye on the diversification of that supply chain. So we would typically say there, you're correct in identifying that there are physical risks that matter, but unless you have points of concentration in that supply chain where you have a degree of kind of a line of sight and the ability to engage and to manage and to help that facility manage its risk, there's not that much you can do. The other thing is that all your competitors also face the same risks. So, you can take a degree of comfort in the fact that since this is systemic risk, um, it's not going to be you alone that feels the impact if it plays out. Whereas if you're making something much more specific, let's say a high-tech product, or some kind of raw material where your manufacturing sites are your primary asset and really critical nodes in the supply chain for getting your product to your customer, then it makes sense to think about risk in idiosyncratic terms. I am specifically exposed to this one location. It really matters to my business. I'm going to think deeply about the different ways in which it might be exposed to more physical extreme weather events as climate change progresses. And I can do something about that because I can intervene physically. I could maybe make sure that materials are raised off the ground, electricity supply is raised off the ground if floodings are concerned, and in managerial terms. So I can make sure that the emergency planning protocols are in place, that appropriate insurance is in place, and so on. So that distinction basically um, between a kind of distributed and systematic exposure to physical risk and a really concentrated and idiosyncratic exposure, I think can be a bit of a blind spot or a point of confusion for clients.
I appreciate the elaborative answer. It gives us a clear breakdown. Now, Unwritten as a software, can it truly keep the pace considering the climate is changing constantly and we have natural disasters every now and then in different parts of the world? So, if you can throw some light on that.
So we offer both pieces, meaning when you're thinking about forward-looking physical risks, so natural disaster risk, as your question implies, you're usually thinking about increasing exposure. So you're not trying to specifically predict when one event is going to happen. You're saying, what is the increasing likelihood that this type of event might happen in a time frame that's of interest to me? So let's say I'm going to look at over 10 years and I want to know how much more likely it is or how bad a worst case could be for a flood. That's quite a different exercise as a forward planning exercise from I must be notified of a flood as soon as it happens so that I can put my emergency response protocols into action. Both of those things are important. They're just different. One's a planning exercise and one's responsive. And our platform uses um, all the sorts of forward-looking statistical modeling that you would imagine for the planning exercise piece. And then we do live tracking of news and satellite data for the live response piece.
I see. Maybe you all have some collaborations with the forecasting agencies across the globe. and that could be an additional value. Now, while you are building Unwritten, although there are so many climate sourcing tools, what are the USPs that investors or your clients could find in the software?
Yes, I guess I would say I wouldn't call it a climate sourcing tool. We're very specifically a climate risk tool. So you're using our product if you need to think very deeply about the risks to a specific business, whether it's your business or a business that's in your portfolio and the assets that business holds. Um, Within that subcategory of climate risk, the thing that sets us apart above all is the depth of our coverage on transition risk. So physical risk has been, excuse me, physical risk has been, I think, covered for longer in some ways in terms of very specific and detailed forward-looking modeling. And there are a range of tools out there. So well-known names would be perhaps Jupyter or First Street or Mitiga. A lot of those solutions were built for the banking sector. So you're thinking about, I've got a huge portfolio of property loans of different sorts, and obviously I'm very concerned about how those loans play out. And I want to make sure I've correctly priced them, and I've also stress tested my portfolio to particular events.
I
On the transition risk side, I think that a lot of the modeling approaches in terms of that kind of forward-looking, what exposures should I think exposures, excuse me, should I be thinking about into the future? A lot of that has been a little bit underwhelming, and it's really been anchored to carbon pricing. So it said, basically, I'm going to say that the only transition risk that companies care about is the price of carbon, and I'm just going to offer different projections for how that price of carbon could evolve. And I'm going to, find a mechanism of applying that to the company's EBITDA or their cost base or whatever. In reality, most companies do not face very material risk from direct carbon pricing, and if they do, they know about it. And the transition risks that matter are much more nuanced. They're about the specific policies that you face in your core markets or in new markets. They're about the chance of being sued for greenwashing or environmental pollution. They're about the technologies that your competitors might adopt that compete with the way that you make your products and the way that you distribute them. And it's impossible to capture all of those things in a single carbon price number. And so we took the approach very early on to say, we're just going to try and give people all that information and help them carve a road through it. Because in our use case, when you're thinking about risk and diligence, false negatives are much worse than false positives. And it's really important to give people all the information and allow them to decide what matters and what does not matter.
see. That's very insightful because in-depth knowledge is definitely needed while you're making those investment decisions. Now, my next question to you is uh, of course, there are a lot of real world financial implications if you disregard the climate risk factors or without integrating the climate risk into the core strategy. What has been your, what do you observe? Like, what is an average amount or the financial implication that the company incurs if it disregards so?
Do you mean what is, if I was to put a dollar number on the average amount of climate risk faced by any company, what would it be? Or what is the penalty for failing to comply with regulation that forces me to consider my climate-related risks?
Apart from the regulation, in actuality, what are the financial implications? Regulations, of course, there are a lot of implications out there. But beyond regulation, say if you don't have any regulation, still they are facing some kind of implication. So, what is an average score on an average number according to you?
I think it would be impossible to give a meaningful answer because it depends so much on the kind of business. So, if you are operating, a software and services business, unless you, I don't know, specifically service the energy sector, for example, the chances are that your climate risk exposure is quite low, and that's fine. It doesn't mean that it's not worth being aware of it. Um, Climate risks tend to be higher in businesses that are a little bit more asset heavy, so they have that kind of concentrated exposure to particular sites that I was talking about. And then, of course, to businesses that are focused on sectors that are transitioning more rapidly. So energy, mobility, housing, heating, insulation, certain aspects of the services sector, to be fair. So I would say the risk is going to be distributed very unevenly depending on where you operate, the kind of business, your business model, and the sectors that you're in.
And if we consider the regulations, then what kind of financial implications do we foresee?
Well, generally, the regulatory burden around climate risk is not that heavy, right? So there's in most jurisdictions where there is some degree of uh, generic regulation relating to climate risk, it simply says you just have to disclose your risks on an annual or biannual basis. In a prescribed format. So I need to make sure that my investors know that and the public knows that I've conducted an exercise through which I've considered all of my risks, and I've thought about transition risks and physical risks and carbon, and I've put those out in a public report. And the penalties for non-compliance not that stringent. I believe in under the new Californian rule is $50,000. So it's going to be slightly cheaper to comply than not to comply. Basically, I guess that's the intention of that price point. Um, where there are some more stringent regulatory burdens, it kind of is in very particular sectors. So if you think about local planning rules in areas that are known to have high wildfire or high flooding risk, for example, there might be not just the exposure to fines for failing to comply with particular regulations to manage those natural physical exposures, but actual, say, prohibition. So you will not be allowed to operate, you will not be allowed to build in this place unless you do it in this particular way. And oftentimes those regulations are not necessarily going to be framed as climate risk regulations, but implicitly climate is a part of the sort of risk behavior, risk appetite that they're trying to manage.
Yeah. Agreed. Now, as we are speaking about the regulations, how do you see regulatory shifts and carbon pricing transforming investment decisions over the next coming decade?
Although a decade's a long time in climate and sustainability. And if this last year or so has taught us anything, as we've seen, the upending of many climate and sustainability agendas, particularly in the US, but elsewhere in the world as well, um, it's that a lot can change quite quickly in an area that is so politically exposed, as it were. But there are some interesting trends for me in terms of the continued gradual spread of TCFD style, so mandatory climate risk disclosure rules. Obviously, the California 2026 reporting deadline is particularly significant, but there are also new rules either coming into place and or progressing in terms of the kinds of companies and scale of companies that they capture in many other jurisdictions, so Brazil and Japan and Australia and the UK and Europe and so on. And then in terms of carbon pricing, I think the thing to be looking at is carbon border adjustment mechanisms, and particularly the introduction of CBAM reporting and infrastructure. It's been going on for a while now in Europe, and then what effect that's having on manufacturing nations, particularly China, in terms of whether they are then effectively forced to impose their own tax to match the border tax that's imposed in the EU.
I see. Very interesting. Now, since you have so much of experience in this space, what are the two or three climate risk indicators that you believe will break into the financial models in the next 5 to 10 years?
Could you say a bit more about what you mean by indicators there?
For example, certain climate risk indicators would, in a financial statements, certain climate risk indicators should be integrated in totality.
Um, so if you're, I guess if you're trying to make a common sense assessment of whether a business faces significant material climate risks, and then whether it has integrated those into its operational risk management strategy and its financial planning, you would be looking at things like the sectors in which it operates, the concentration of its physical assets as discussed. So is this a business that makes something very technical in one place with a high degree of expertise, with lots of expensive machinery that's hard to replace or to move, for example. And then, sector-wise, again, proximity to the transition, proximity to asset-heavier industries, obviously infrastructure assets, anything with infrastructure exposure, you want to be thinking a lot about both physical and transition risks because infrastructure is often closely linked to transportation and mobility sectors, which are all transitioning quite rapidly. So those would be some indicators I would look out for.
And that's a very good point. Now, coming towards the end of our show, how can tomorrow's leaders build careers at the intersection of climate, data, and capital?
I look, there are many such intersections, and oftentimes the things that are most impactful are the ones that no longer seem that innovative and exciting, and that's because they've just become part of the normal fabric of the economy. So it's no longer particularly novel to be investing in renewables because in most parts of the world, the fastest generation capacity being added to the grid is some form of renewable generation capacity. And yet, being involved in the funding and management of renewable assets is one of the most critical things that any individual could be doing to be contributing to the transition.
That's
In the work that
excellent.
I
Anything
do, sorry.
that you would like to mention?
I was in the work that I do, I suppose what I hope to see really is climate risk transition away from being a specialist sustainability concern to again just being a matter of routine. So not something special and not something interesting. So when we buy a new business, when we invest in a company, we think about all sorts of things. We think about credit risk, we think about its customer base, we think about its competitors, we think about climate risk, we think about cyber risk. Just part of the kind of good operations and effective due diligence you would do for any business. I think it's when things become routine and boring that they are most effectively implemented.
Excellent. Your vision for the coming 3 years for Unwritten?
To continue to bring on board new customers and to be able to do interesting and impactful work. So some of the work I'm most excited about at the moment is not actually the work that makes us the most money. So it's not necessarily big high profile contracts in the financial services space, but it's working with, say, local regional councils to help them in their adaptation planning. And that planning will make a big difference to the safety and prosperity of residents for decades to come.
Great. Thank you. We do have Gayatri and Upendra also with us. In case if you all have questions or if any of our other audiences have questions, how can they reach out to you?
I would say, since this is being broadcast live on LinkedIn, I'm pretty responsive on LinkedIn, so please just drop me a message there or via the Unwritten website, which is unwritten.co.
Thank you. Thank you for joining us. And it has been an honor to talk to you and learn about the initiative. And we wish you all the very best and looking forward to support and engage with these initiatives. Thank you.
Thank you so much. It's been my pleasure.
Thank you.